the 3 P's related to investing, and then tonight is our third. And so I am going to stop and pause here and turn it over to Tiffany Eubanks Saunders, who is our market executive with Bank of America. Tiffany?
Well, thank you, Adrienne, and thank you, ladies, for joining. For those who are new to the series that Adrienne mentioned, welcome. And for those who are returning, thank you, thank you, thank you for your time, your energy, and your interest in a topic that I think is probably more materially important now than ever before. And that really is around Black women and wealth, and making sure that we create education and awareness amongst ourselves in terms of how do we ensure that we are creating and motivating economic mobility, not only for us and our family, but the community in general. And we all know that Black women play such a tremendous part in not only the Black community, but community at large. And it's important for us to really understand some of the key inputs to not only creating wealth today, but as importantly, creating generational wealth. Because as we've all seen, and we were just having the conversation around COVID-19 and the pandemic crisis, we all know far too well the disparate impacts that COVID has had on our community, as well as the Brown community. And a lot of those impacts really come from the current state of Black wealth that we are in as a community. And so I cannot be any more pleased and honored that Adrienne and this Spelman alumni chapter chose to partner with Bank of America to put together this 10-part series that really allows us to explore the key components of financial and wealth management, things that people have never taught us, things that have never been targeted to us as Black women. And I'm also very proud at the fact that we at Bank of America have Black female advisors who are experienced and subject matter experts, some of the best in their fields, working for us, who can deliver this information to you directly. So without further ado, I want to make sure we spend the majority of the conversation talking about the basics around taxes, because we know that what we anticipate is what we have today will probably change going forward, given the current political or presidential election that we had a couple of weeks ago. But I'm going to turn it over to my esteemed colleague, Tara Butler, and let her take us through tonight's discussion. Tara?
Well, thank you, Tiffany. And I want to thank everybody for inviting me this evening to talk with you all on Tax Matters 101. Just kind of as an overview, this is kind of getting you ready for Tax Matters, I believe it's 201. So that I'm just going to go over some basic information as far as understanding how income taxes are calculated, why do we pay them, between an above the line deduction, a below the line deduction. And I'm just going to touch on a couple of things that can help minimize your taxes, but also if you end up with a refund, what do you do with that refund? And, you know, spoiler alert, shopping is not one of them. So I'm going to share my screen with you all. All right. There we go. All right. So again, as I mentioned, this is kind of just an overview of what we're going to talk about how income tax is calculated. We'll talk about what is taxable income. You may hear terms. Sometimes you'll hear gross income, you'll hear AGI, or you'll hear taxable income. Well, what's the difference between all of those and how that affects how your taxes are calculated? The different types of income, how do you pay your taxes, a different way to do that, but then managing your income tax position, and then some tax refund tips. So I want to start with this quote. And the first time I heard it, I found it so interesting, considering this was an actual quote from one of what people will consider one of the smartest men who ever lived, Albert Einstein, who said, the hardest thing in the world to understand is income tax. So my thought is, well, if he can't understand it, how am I going to understand it? So I think that just being able to understand what goes into it helps us to understand what a tax efficient strategy is. How do we save on our taxes? When you start hearing, again, with the more advanced tax course, and you start hearing some of these strategies to understand how it's actually saving you money and building you wealth. So first, income tax. Why do we have it? Well, first of all, I say, well, I don't like paying income taxes. I like having roads. I like having firemen. I like having some police, different things that I do like having available to me. While I don't like, war, the ability to protect this country. I like being able to drive on a, paved road. I love having hospitals. Those are all things that are actually covered by our taxes. So while it is something that is necessary, it is something where I go, we shouldn't pay more than what we need to. And so one of the ways is when you understand how your income tax is calculated, then you can also understand how you can reduce that tax or even take advantage of some of the tax benefits that are out there. So the best things in life are free. Sooner or later, the government will find a way to tax them. So how do they tax our income? Well, here's a nice little colorful chart I have for y'all to understand how it's taxed. And I'm going to go over each one of these in more detail, because first you have your total income or your gross income, less any above the line deductions, and that equals your adjusted gross income, here termed as AGI. Then you have your below the line deductions, which then gives you your taxable income. It's that amount, that taxable income, that's the amount that actually gets taxed. So it's not really your total income that ends up getting taxed. So let's start with the total income. What does that include? That includes your salary, your bonuses, your commissions. Your total income includes in your investments. I know you spoke at the last topic was on investing. So your interest, your dividends, your capital gains. For those of you who own businesses, your partnership income, if you're the beneficiary of a trust, it would include those different items. Again, gross amount. What it doesn't include is if you get a gift, if you get an inheritance. There are certain funds or bond interests that are not taxable. You sell your home, there's a limit to it, but also that's not taxable. Any distributions from a Roth IRA or 529 plan, as long as it's used or taken at the appropriate time for the appropriate expense, and then insurance proceeds. Those are all things that are not included in your total income. Next, I want to talk about deductions and credits.
Oh, this is good. This is all about taxes, deductions, credits, everything.
Thank you.
Oh, no. Oh, I'm so sorry. Oh, my God.
No problem.
I'm so sorry.
We can make this interactive.
You're
It is this
fine.
time.
Mute
Oh, my
yourself,
God.
Anthony.
I'm so embarrassed. Okay, I'm muting myself. I'm eating dinner with the family. I'm like, you all should listen. Okay.
Yeah, have everybody sit around the table and talk about taxes. Nice family event. But okay, so deductions. You may hear them be referred to as write-offs, but these are things that will actually lessen what your taxable income is. Again, when you think about how it is taxed, we want to get as many deductions as possible, because that way we have less of our income that is actually being taxed. Now you get, and we'll talk a little bit more about, you can either do a standard deduction. So depending on how you file, if you're single, head of household, or married, that'll change the amount that you're able to deduct. So for example, if you had $50,000 in income and you took a standard deduction, really you're not paying taxes on $50,000, it's on that $50,000 less your standard deduction. That's what you're being taxed on. Now, if you decide to itemize, which would be a little bit different, you would list all the different things that would be counted as an itemized deduction. Real estate taxes and other things that will be considered in itemized. So that deductions will reduce your taxable income. Credit, on the other hand, gives you a dollar for dollar reduction of your tax liability. So what that means is, instead of it lowering the amount of income that's being taxed, once you've actually figured out what your tax amount is, and let's say that you have you owe $1,000 in taxes. Well, now you're going to look at your credits. That'll give you that dollar for dollar. So in this example, if you have any foreign income taxes to another country that you've paid, you get a credit of $100. So instead of $1,000, now you're paying $900. So again, this is taking off from your tax liability what you owe. So that's the difference between the deduction and a credit. So now let's talk about above the line deductions. These are ones you're probably more familiar with. And above the line means before AGI is calculated, this is a deduction that you get. Some more common ways of think of expenses that you pay before taxes. You pay, if you contribute to a 401k, that's a pre-tax contribution. If you contribute to an IRA or a health savings account for certain child care expenses, all of those are taken out, and it's pre-tax, so it's above the line. So before you have your taxable income. So those are a couple of the above the line deductions. And again, it'll lower what your adjusted gross income is. Once you have that, you have the below the line deduction. And again, that below the line deduction is now where you get into your standard deduction or your itemized deduction. So let's say, for example, you have $50,000 in earned income. You contribute, I'm just using an amount, $10,000 to a 401k. That's an above the line deduction. You then have $40,000 income is what's actually being your adjusted gross income, your AGI. But then you get your below the line deduction, and let's say you're single, and then you take the standard deduction. Well, it would be that $40,000 less the $12,400. That would give you your taxable income. Now, if you decide to itemize, there are certain expenses with some limits that you're able to do. So you could do medical expenses, but it has to be more than 7.5% of your AGI. So in that example, if your AGI ends up being, let's say, 40,000, your medical expenses have to be more than 7.5% of that 40,000 in order for you to be able to itemize that deduction. State income, real estate, personal property, mortgage interest on a qualified mortgage, or some investments, and charitable contributions. Those are all things that you can do a below the line deduction for. So what you would do is see which one gives you the higher deduction. Is it the standard deduction where it's a fixed amount, or you can list all your itemized deductions and see whichever is higher, and then that's the way that you would want to go in order to figure out what your taxable income would be.
Hey, Tara.
Yes.
Real quick before you leave that slide, I think one of the areas that we get the most questions about from our clients has to do with the charitable contributions component. So can you talk a little bit about and share with the ladies this evening, what are the parameters? Are there any limits or maximums? Share a little bit more about what they kind of the parameters of charitable contributions and how to leverage them for those deductions.
Right. So so you do have limits as far as what you're able to list as an itemized deduction. And this was a change that happened probably 2-3 years ago, where it changed the amount, and it actually made it so that more people end up taking this deduction versus the itemized deduction, because there is a limit for the charitable contribution. So again, this limit, which typically in most cases would be about $10,000, you would essentially have to contribute more than that in order to have a charitable contribution count. So before, let's say, for example, if you made charitable contributions, let's say to your church, and maybe every year you gifted 5,000. Well, under the new tax laws, you may not be able to count that deduction. And so, and another strategy, which maybe tax 201 class, is what we call a donor advised fund. And actually anybody can open up a donor advised fund, where you would put enough in there so that you qualify for the charitable contribution. So let's say you end up putting, 20,000 into a donor advised fund. In that case, you go, but I only want to gift 5,000 a year. Well, you can do that. You can get the full $25,000 deduction. And then over the next 5 years, you could do a $5,000 contribution to your church over the next 5 years. So you're able to get the deduction in 1 year and make those gifts over the next 5. So that's one strategy in being able to itemize your deduction. Again, work with your tax advisor to see what was going to be most beneficial for you to be able to do that, and to make sure you're meeting those limits before you do that. Any other questions?
No, that was great. Thank you.
I have a question for you, Tara. This is Adrian.
Yes.
When you're talking about the above the line and below the line above the line and below the line credits versus deductions, is that the same? Are the same rules? Do the same rules apply if you are a small business owner? Because we have some small business owners on the line, and so I want to make sure that we're speaking to how they would be able to apply this, not just with their personal taxes, but for their businesses as well.
Right. So for the business owners, and again, it depends on how they own the business. Is it owned as a sole proprietorship? Is it in an LLC? Is it an S Corp, a C Corp? All of that will change. For this, let's look at if it was owned as an LLC. So it's going to be viewed as owned by them. In that case, their deductions, we're going to start now looking at below the line deductions. So for example, if you own a home, or excuse me, if you own a house and you rent the house out, you now have rental income. That would be an itemized deduction. That would be a below the line deduction. So most business income, and for that matter, losses, would be on the, again, for rental income, I tell you offhand, that would be a Schedule E. So when you start seeing all these different schedules on the tax return, that's determining what that below the line deduction is for business expenses.
Thank you.
That answer, okay. Awesome. Let's see. Yep, we left off here. Another deduction, as we talked about, when you own a home, if you do itemize, is that the interest that you pay can be a deduction. Again, with the changes in tax laws back in 2017, it then put a limit of how much you're able to. So as long as your home mortgage was $750,000 or less, you are able to then have a deduction for both the interest and any points that may have been paid. If you bought a home before 2017, before December, I believe the date was December 17th, 2017, and the mortgage was higher than that, it was grandfathered in. So you still are able to get the deduction. But now they capped it at $750,000. And so now that we've kind of figured out, here's my total income, I'm going to take my above the line deductions, being that I'm going to start contributing to my 401k, I'm going to do my pre-tax deductions, I get my AGI, and then I decided either I'm going to take a standard deduction or I'm going to take an itemized deduction. I now have my taxable income. So that's the amount that's actually going to be taxed. But how much are you getting taxed? Well, again, that's going to depend on your filing status. So if you're single, and let's say that you earn, again, I'm going to stick with the 50,000 just as an example. If you're single and you earn 50,000, your taxable income ends up being 50,000, then your tax rate is going to be 22%. But keep in mind that this is a progressive tax rate. So this is what this means, is that the first 9,875 is taxed at 10%. Then the 9,876 to 40,125, that's then taxed at 12%. Then any amount above that is taxed at 22%. So it's progressive in the amount of taxes that you're paying. Now, if you're married and you make that same amount, well, that actually puts you in a 12% tax bracket. So your filing status matters. And for those of you who are filing head of household, I don't have those numbers here. Again, that's a different filing status. Now, you are penalized if you are married and filed separately. You will be penalized for not filing jointly. And so you may see that you're paying a lot more in taxes if you decide to file that way. So it's more favorable to do to file jointly when you're married. Now, with this current election, and if things continue in the way that it's more than likely going to happen, is that these rates may change. And so one of the things is to keep in mind is how important that when you're following what's going on, looking at what their tax platform is, because that's how it has a direct impact on you, is that if they start changing the tax rates and you go, well, what difference does that make to me? Well, you could potentially be paying more or less taxes depending on how they change not only the rate, but also the income limits within that rate. So again, right now you can contribute over 19,000 to your 401k. It's 19,500. But they could change the law so that you can contribute more, which would allow you to then lower your taxable income, because that would be an above the line deduction. But let's say they lower that amount of what's, more than likely it will not be lowered, but that could happen. It's the same thing when the laws change. Think about the previous example of your deduction for an interest on a mortgage. There was no limit. The new tax law changed it to where there became this limit that was on how much you can deduct. So again, all these tax laws has a direct impact on how much you're actually paying when it comes to your taxes, and understanding how those tax laws affect you will help you to then make better decisions and choices as far as, do I contribute to a 401k? Do I contribute to a regular IRA or a Roth IRA? What do I do with that? How does that affect my overall income tax? For the business owners, do I have my business as an LLC, or do I do it as a S Corp or a C Corp? It will change how everything is taxed at that point. So again, knowing what those numbers and rates and limits are going to be, and working with your tax advisor can help you to see how they're going to impact you and your family.
Yeah.
And
Tara, hey Tara, real quick. So one is, Adrian, I was going to tell you, if you all would like, we've actually created some position papers on the tax and the policies for each of the presidential candidates. And so we can share that information if it's helpful, just so that people kind of know, the ladies kind of know the direction and some of the policies that President-elect Biden has set out in terms of his tax plan. I think most people have heard him say that, I think it's, Tara, I think it's 450,000 is kind of that cap level that he has very clearly articulated, that I don't plan on, my policy, my tax plan doesn't have an impact for anyone who makes, or households who make or earn less than $450,000 or less, but it gets a little bit more specific about what some of those impacts may be if you're over that. The other thing, Tara, that I'd ask you, I wanted to see if you could make sure that we had good clarity on in this session is when we talk about income for the purposes of taxes, can you talk a little bit about, many of the ladies on the phone are probably receiving some type of total compensation from their employer, where it's not just base salary, but it's base salary plus some type of bonus, which might include some type of stock or option. Talk a little bit about what the definition for the purposes of this chart and determining what your tax rates will be, what's included in that income category.
That is actually a great transition to capital gains and losses. Part of for executive compensation is you can get restricted stock units. Not so popular anymore is non-qualified stock options. Stock options used to be a lot more popular, but now you get more performance stock units or restricted stock units, which could be part of your compensation. So there's really two types of income. You have ordinary income, and then you have capital gains income. And the difference between the two is that your ordinary income, let me go back here, will get taxed at anything that qualifies as ordinary income will get taxed at one of these rates, depending on what your taxable income is. However, capital gains is when any gains that you have from selling a stock, bond, or real estate, or any investment. So it would be a capital investment that you've held longer than 1 year. You have to hold it longer than a year. So it could be a year and a day. And once you sell it, it's then taxed at a more preferential rate of 15% or 20% if your taxable income is greater than, let's see here, $441,450 if you're single, and $496,600 is if you're married. So again, for the majority of people, it'll fall at that 15%. So having that capital gains gives you that amount that will only be taxed at the 15%. So let's say that your taxable income ends up being $210,000. You will fall in that 35%. Your capital gains only taxed at 15%. If you have a loss, and again, this can is also with business owners, if you have any losses and it's a long-term loss, you can that becomes a deduction for you. And you can, what's called a carry forward, you can carry forward that loss. Here in this last bullet, lets you know that you can deduct up to $3,000 of your ordinary income for the tax year. And any unused losses can be carried forward. So you can continue to carry that forward and use $3,000. So if, let's say you had a loss of, let's say, $12,000, you could deduct $3,000 for the next 4 years and use up that loss, again, minimizing your taxes. So when you're, and I'm not sure, Tiffany, if they talked about this in the investment section, when you're looking at, when you're buying and selling stock and, making sure you want to hold that stock longer than a year, because if you hold that stock less than a year, it's considered a short-term capital gain. And then you're now being taxed back at that 35% tax rate. So you don't want to, go in there and buy stock and then 6 months later say, oh, I changed my mind, I'm gonna go ahead and sell it. You're going to be creating ordinary, basically short-term capital gain, which is taxed like ordinary income. And so when you are, for those of you who are getting this executive comp, you always want to sit down with your tax advisor and see what kind of income you're going to have coming that year, and to see, do I need to do some tax loss harvesting, which I'm pretty sure they talked about that in the investment section, so that if you see that this particular year, I know I have some capital gains, I know I'm selling some stock, or I have some RSUs that are coming in, that are going to be vested and I'm going to be selling, you can look to see how much you're going to increase your income. So one of the things to keep in mind with that is typically you'll have a time horizon for when you can sell a stock. You don't want to sell it and then push you into the next higher tax bracket if in fact you can hold it another year. So that would be another strategy to have, is to say, you know what, I'm in this 32%, my taxable now is at 205,000. If I go ahead and exercise these RSUs, it's going to push me into the 35% tax bracket. I may want to wait until next year to exercise them.
So-
Another strategy could be, if I see that the tax rates are going up for 2021, I may want to go ahead and exercise these in 2020, if I'm in a lower tax bracket. Again, keeping track of what's going on with the tax rates and how your income is going to be impacted by that.
So Tara, I have a question for you, because we've
Mhm.
been living during this COVID time period. And I know a lot of ladies have been doing their own investing, whether it's through Merrill Edge or Robinhood or some other app, right?
Mhm.
And you've seen a lot of what they've been calling the COVID stocks, for instance, right? You've seen these run-ups on
Mhm.
platforms like what we're on right now, Zoom,
Right.
going from $100 to $500, right? And then
Mhm.
it's going back down. So I just want to make sure that we are clear,
Mhm.
because our last session, we talked about one of the principles in investing is it's a long-term game. And during this time period, I know that people have been picking and choosing and selling off. So if they do that, I just want to reiterate what you stated. If you sell it before a year's time, you're going to be taxed on those gains at a 35% level, which may be less than what the appreciation of that stock actually was.
Right. So whatever your tax bracket, whatever your tax rate is, it may be 32, but whatever your ordinary income tax rate is, that's how it's going to be taxed. So if you owned it for 364 days and you sell it a day short, that will be taxed, and you will essentially be paying, in this example, if you're in the tax bracket of 35%, you're paying 20% more in taxes than what you need to if you would have just held it another day.
Right.
So you don't want to be in there buying and selling in the same day. And, I had a client once where, they kind of came to us and they couldn't understand why they had this huge tax bill. And I said, okay, well, let's sit down and figure out what you did. And he was like, yeah, but I made all this money on the sale. And then when we went through it, we said, yeah, but you bought and sold it within 8 months. So it was taxed out of, and they were at the top tax rate bracket of 37%. So they end up paying a lot more in taxes. And then their thought was, but why didn't anybody tell me that? And so that's why it's important to work with a tax advisor, working with a financial advisor when you're making these decisions, to see what is the impact going to be. And you're right, investing should really be for the long term.
That's right. That's right.
Yeah.
And the
Thank
rule
you
of
for that
thumb, to
clarification.
your point, the rule of thumb, Tara, really is quite simply, investing, when you think about investing and how it relates to taxes, it really comes down to, think about this. The federal government taxes you annually, right? There's an annual income tax that everyone has to pay in this country. And that's the time frame of when this country and our policy defines income. And so anything that happens in that 12-month period is going to be considered as income, which makes it subject to the regular tax rates that Tara is showing on the screen here. Anything beyond that is considered a capital gain and can be taxed at a much lower rate. And that hence the reason why we do advise our clients to invest for at least a year, so that they're not eating up what they thought was profit from selling, buying low and selling high, but then they have to end up paying so much more tax on the profit that they made between what they bought the stock for and what they ended up selling it for.
Yeah. And I mean, and just from a personal note, these were not conversations that I personally had with my parents when I was younger. And so having this conversation now and having it with your children, your teenagers, so that they understand how taxes work. And I saw this great illustration. I didn't put it in here, but it had a kid with an ice cream cone, and it said, to teach your kid about taxes, take 30% of their ice cream cone and let them see how they feel about you taking 30% of their ice cream. They don't like it, but they need to understand this is what happens. You feel like, but this is mine. And it's like, I've earned it. It's mine. And the government comes back and says that other quote, they're going to find a way to tax it. And so when you're creating that generational wealth, you're creating it because you figured out a way to earn income that is taxed at a lower rate than, a salary. So I have a salary that's taxed higher than my investments. So I'm going to put more money in my investments because in the long term, that money gets taxed lower than what my ordinary income does. So again, and I think an important lesson to have and, to teach to your children so that they can kind of start off ahead. One of the things, again, growing up, what I would hear is you buy a house. That's your first big asset is you buy a house. And they're right, because typically in most markets, the value of your house is typically going up. And so, but not realizing that's actually capital gain. That's a capital asset. And one of the reasons why you want to own it is that if you sell your home and you've lived in it 2 out of the past 5 years, that when you sell it, you can exclude up to $250,000 of your gain. So again, you may say, well, why do people buy and flip houses? Because if they buy it and they live in it out of the 2 of the 5 years, they sell it, all that money they made is theirs. The government doesn't get any. And then you take that money and you put it into another house. Then you fix it up, you see the value goes up, you stay in it 2 out of 5 years. Again, that is another way of creating capital gains and exclude. And this is one of the best ways is because if it's your primary residence, it's very different if you buy it for investments. Or for investment purposes, is that you're able to exclude. And it's $250,000 if you're single, but it's $500,000 if you're married and you file jointly. So again, here's another way of excluding some of that income and not getting taxed.
So Tara, we're going to ask you to review that one more time.
Sure. So I'll give an example. If you buy a home and let's say you paid $500,000 for it, and you had that's what you paid for it, and let's say you sold it for $750,000. So because you paid $500,000, not your basis, you sold it for $750,000. So you had a gain of $250,000. If you're single and you did that $250,000 is tax-free. If you're married and do that, it's very much tax-free because you actually can do up to $500,000 and it would be tax-free earnings on the sale of your home.
And that has to be your primary residence.
Right. So, yes. So to qualify, it has to be your principal residence, not a vacation home, not a second home. And you have to have lived in it 2 of the past 5 years prior to the sale. Mm-hmm. And you could not have claimed this exclusion over the previous 2 years, which to me automatically happens if I have to live in this house for 2 of the 5 years. I couldn't have done this. Like I'm going to bypass that. So yeah. Mm-hmm.
Hey, Tara, I was just going to remind the ladies that during our first session, when we talked about the state of Black wealth, we talked about the fact that the good news is, to Tara's point, it's important to own homes and residences, and that in the Black community today, we're almost at about 50% home ownership, probably somewhere closer to 45%. The challenge that we have is in the value of those homes. And so to Tara's point, you're seeing why it makes sense both in the purchase of the home and making sure that we are identifying homes in areas that will appreciate in value. Because when you go to sell that home, as you see here, if you've lived in it 2 of the prior 5 years, or 2 of the 5 years prior to selling the home, then you're actually able to leverage that as a real investment when you make the sale, because you're not being taxed on the profit that came from owning the home, selling it at a higher value, and then being able to take the gain completely tax-free. So that's another alternative way of creating an investment around that primary home. But what it means is that we may have to go into or identify homes that are a little bit smaller or have fewer amenities when we first purchase them or live in them, knowing that the area around that home is being revitalized or improved so that when we sell the home, it sells for a much higher value. And then we've got a good investment gain off of that home purchase as an investment.
I remember I was about 20, I was actually 22 when I bought my first home. And I can remember, and it was a really nice little white lady who lived next door to me, a little Italian lady. And she said to me, now you sell this house, you buy and sell every 5 years and you move up. And before you know it, you're going to be living in a house you want to, and you're going to have all this equity. Now at that time, I didn't understand what she meant. But as time went on, I understood when she said every 5, she didn't explain it to me like this, why I need, stay in there for 5 years. But she said, and every time you sell it, you take that money and put it into your new house. You put that as a down payment, and then you move it to a nicer house, and each house gets nicer than the one before. And you'll find out that you've been moving and you eventually got to the house that you wanted, and you never had to come out of pocket any more money. And again, this is how you create that generational wealth. And now you have all this equity in your house so that if something were to happen to you, here's a real asset that you have available to leave to your family. One that's not burdened with a mortgage. And that by the time they may get it, maybe the family members can't pay for the mortgage, or they try to sell it and then they're not getting enough. Again, a real asset to be able to, to create that generational wealth. We have a lot of clients who speak of their family homes. It's a home that's been within the family for generations, and it's there for a reason. It has sentimental value, but believe me, there's a monetary value that's there, and that's why they keep it and then pass it on to the next generation. Any other questions on the sale of the gain from the sale of your home? Well, now we come to the hard part, actually paying your income taxes. Now, we know April 15th is tax day. And if you can file for an extension, and that extension will put you all the way to October 15th. But did you know that if you owe taxes and you file for an extension, you still have to pay those taxes on April 15th? Because even if you don't, and I love the way the government does this, they give you an extension and then they find you interest to do it. And I don't know if people realize that when you file for that extension, you're paying for it. The government's not giving you that extension for free, because you have to pay interest during that time. So again, it's more beneficial to pay your taxes on the 15th. And sometimes, especially for business owners, a lot of times they have to wait for certain information to come in and they're not able to file by April 15th. So understand that may happen, but you want to be able to do that. Some other deductions that I did not talk about is if you have children. That is another deduction that you have available for you. If you are single and file head of household, you actually get a higher deduction than when you're single. You will get your forms, and if you find that you're owing money every year, you may want to take additional money out. And that's that form. Whenever you start a job, you fill it out. And most people never think about the form W-4 again. What I'm going to say to you is if you find yourself owing and you don't want to write that check, then what you could do is go look and say, okay, maybe I need to withhold a little bit more. If you just don't want to write that check. I personally rather write that check because I can do more with that money and investing it and then paying it. But again, this is something you want to revisit every year and make sure that you have the right amount being withheld from your W-2s.
Hey, Tara,
Mhm.
before you leave that point, can you also speak a little bit about the change in the tax law that occurred where, to your point, taxes are due on the 14th, but there's also a change, or I'm sorry, the 15th, of April, but there's also a change that occurred a couple of years ago where if you are not taking out enough throughout the year,
Mhm.
then the government is actually dinging you for you're actually being penalized for not withholding enough taxes throughout the year before you actually are assessed your total tax income. And talk just a little bit about that, because I think most people don't really know. You know, it's nominal for many people, but it's good to know and understand so that, to your point, if you want to take out a little bit more each pay period, then you can go ahead and do that.
Right. So great segue to our next slide that does talk about doing estimated payments. And again, there is a penalty if you keep underpaying them, because basically what the government is saying, you owe us money and you keep not making us wait to get our money. So we're going to penalize you for owing us this money. So what you can opt to do is do these estimated payments. And generally they're going to be due April 15th, June 15th, September 15th, and January 15th. Those are the 4 times that you're going to pay them. And what they'll do is they'll look at your previous tax return. And as long as you pay about 90% of your actual tax liability for the year, and you make these quarterly payments, and these are going to mostly be for some people who are self-employed. This is where this comes in when you're self-employed and you have to make these estimated tax payments. And this is to make sure that the IRS is getting their money and they're not having to wait, because especially with self-employed individuals, what happens is that they typically need all of their money, and then April 15th come and they tell them, I don't have it. And then you end up making payments anyway to pay what you owed the year before and still not paying what you owe for the current year. So to prevent that, you're able to make these estimated payments these 4 times over the year and then not be penalized. You may hear of entertainers, athletes who end up in jail because of unpaid taxes. This is the reason why. When you have a W-2, I have withholding. So any amount I owe is not going to be as significant to somebody who's self-employed and they're not making estimated payments. And when April 15th comes, they don't have it. And they're looking and saying, well, I don't have it. And then that's when you hear of them seizing your assets. Oh, they will seize your assets. They will seize your bank account, your paycheck. They will seize all of it in order to get their money. And that's what you don't want to have happen. Any other questions on payments of your taxes? Right. So now let's talk about how we're going to cut this tax bill a little bit. We're going to talk about managing your income tax position. Now, I've talked about some of these throughout this presentation, but I just wanted to highlight them a little bit more. And I'm sure you're going to hear more about these in the next tax section. So this one is talking about, this first one is eliminating your tax or taxable income. Again, when we go back to how your income tax is calculated and you're looking at what your income is, if you invest in tax-free municipal bonds, the interest that you receive on these bonds are tax-free. That is the benefit to being able, one, you're investing back into the state in which you live. Typically, it's going to be, so for most of you, you're in Atlanta. So if you buy a Georgia municipal bond, the tax-free interest. The interest you get on there is tax-free. Another way is investing in a Roth IRA. Now, what that means is that there's a limit to how much you're able to put pre-tax into your 401k or IRA. Instead of doing a pre-tax, you could do a post-tax contribution to a Roth IRA. So what that means is after tax, you'll put money, and let's say right now you can put $6,000 after tax dollars into a Roth IRA. That money will continue to grow. When you start to take distributions from that Roth IRA, they are not taxable. They're tax-free. So this is a way of eliminating or reducing your taxable income in the future. So again, think long-term investing. Now, there are going to be some limits to how much you can contribute to your Roth IRA. So you would have to check to see if your income is above that limit. If you make over a certain dollar amount, you're unable to make an after-tax contribution to a Roth IRA. This is something I always tell my clients when their children start working for them to start contributing to. Is contributing to their Roth IRA, because more than likely they're going to be within those limits, income limits, and they'll be able to make it. And again, they continue. You think about if you started contributing at age 21, even if you had a summer job and you started contributing in this Roth IRA, by the time you retire, the compounding of the amount that you would have put in there, that minimum amount, you'd be amazed at what you would have available to you at retirement. Might allow you to move that retirement from age 65 to age 60, depending on what you decide to do. So that's one way of eliminating it. Again, you can defer it. So that goes back to your pre-tax contributions to retirement plans. Again, you get this favorable tax treatment. And the reason why you're not eliminating the tax is you're only deferring it, because you'll make those pre-tax contributions to your retirement plans, whether it's a 401k or an IRA. But when you take a distribution out, it will be taxed at whatever your ordinary income tax rate is at that point. If you take it out before you're 59 and a half, you will be penalized. And on top of ordinary income taxes, you will then have to pay a 10% penalty. So again, long-term, you don't want to touch it before age 59 and a half, and you defer the tax. Because again, the thought is maybe during your income earning years, you're in a higher tax bracket. More than likely when you're retired, you will be in a lower tax bracket and you will be taxed less on that retirement income. Let's see, and then reducing tax or taxable income. Again, the more you can get for long-term capital gains, so the more you're able to put in investments, the more that gets taxed as a qualified dividend or long-term capital gains. Is now you're reducing the amount of tax that you're paying, because as we talked before, instead of that ordinary income, you're getting the capital gains 15% tax rate. So those are some of the ways that you can manage your taxes, so that you can take advantage of things offered by your employer. Again, why you should go ahead and invest. Now I'm giving you a tax reason why you should be investing, because that income is going to earn you, the income that you earn from your investments will be taxed at a much lower rate, and help do that. Now, that'll help lower how much you're paying in your income tax. But for some people, they actually get a tax return. So now, what are you going to do, or a tax refund? What are you going to do with that tax refund? As I started off, shopping should not be the first thing you do with the tax refund. And I'm not a fan of getting a refund. And the reason why is because that means you overpaid in your taxes and the government is giving you back what you overpaid. That means you gave the government a tax-free loan of your funds. Now, remember what I said. If you are one day late paying your taxes, they start charging you. They tell you you can wait until October to file, but they charge you interest. And if you don't pay, then you pay a penalty. If you don't pay enough, then you get charged a penalty. So they're constantly charging us when we don't give them their money. But when we get our money, it's a tax-free loan. So I'm 100% in. I try to be net zero as much as possible. But if for some reason you do end up with a tax refund because you have all these extra deductions, or you have any tax credits, is one of the things you want to do is pay off your debt, any debt that you have. Because again, for most credit cards that are out there, interest rate over 20-25%. You want to have an emergency fund. I think after 2008, people really realized the importance of having an emergency fund. Now, this is different than putting your money in savings, because the emergency fund, you want to build it up to have about 3 to 6 months of your expenses, and then you don't touch it. It just stays right there. Savings, you can put the money in savings. You don't earn a whole lot on interest in savings. However, you can continue to build up that savings, and then that's what you can use when you have purchases that you want to buy instead of using that credit card. If you have young children, a great way is to start adding to that 529 plan. You don't get an income tax deduction for making a contribution to the 529 plan, but it is a tax-free distribution as long as you use it for a qualified education expense. That's where the tax benefit is when the money's coming out. Another one is funding your retirement. So if you're able to and you're within the income limits, put more money into your Roth IRA if you're able to. And then my favorite is invest in the stock market. Again, you know, what the other ladies discussed is, you know, your time is now. Now is the time for you to take your money and invest it. When you invest in that stock market, you're investing in yourself, because those are returns that you're going to get back to build that wealth. And you will see how, again, is that, you know, as long as you stay in it for the long term and don't go, oh my God, the market went down 10%, because you want to be there when it goes back up 15%. And it will. You will see the market cycles, but that is money you're investing in yourself. And again, how you create that generational wealth. So that was my little overview of Taxes 101. Trying to be mindful of time. I stopped right at 7:30.
Yes, you did. And I think we have a couple of questions, maybe. I think we have time for just a couple of questions before we wrap up for this evening. Does anyone have any questions for Tara before we wrap up tonight?
No question.
I guess we did a great job of covering it.
I have a question. Is there any way that this can be emailed to us, the PowerPoint presentation?
We can do an abbreviated version of what we sent out. Some of the information our compliance won't allow us to share specifically or broadly, but we can definitely do put together an abbreviated version for you all.
Okay, that's helpful.
And remember, we're going to have a taxes 201. Adrienne, I can't remember which month we've got that scheduled. I think we've got it scheduled for March or April.
It's in March or April.
Yeah.
In preparation for tax season.
Yeah. So, and by then we will know what changes the Biden administration is going to make for income taxes. And we'll be able to talk a little bit more specifically, just like Tara did tonight, about what are the things you should ask your accountant and what are the things that you really need to be looking out for. We'll have a little bit more context and clarity around what are the changes that are most impactful to all of us, so that as you all are looking to prepare for the 2021 tax season, you will have a good sense of what are the things that you need to go ahead earlier in the year and address versus having to deal with later whenever that tax season comes around the first quarter of 2022.
Okay.
Okay, thank you.
So I have one question here, and it is from a rising student, actually. And she's asking if you have a regular job, but you also have an independent side hustle, right? How do you handle your tax costs?
So in that case, that's going to be income that's reported. Basically, you make it a 1099 versus a W-2, because your regular job is going to give you that W-2. But then you have additional income that you're going to add onto your, when you do your tax return, that's still going to be taxed. As long as, if it's just a side hustle, it's still being taxed as ordinary income. It doesn't get any favorable tax treatment if it's a side job, unless it's a business and then you put it in an LLC, hint, hint, then you can actually then start deducting business expenses. So there's a way of being able to reduce your income, so that if you just kind of have this side job and you just kind of have money coming in, ordinary income, you now have business income. And let's say if it's I'm driving and I deliver stuff, you can then deduct mileage, you can deduct gas, maintenance on your car, depreciate your car. There's all other kind of expenses you can now deduct because you now have a business. And when you have, when you create that LLC, that also creates, and I'm probably getting a little off topic, is you want to have some protection, because a lot of people do these things on the side, and if something happens to them, somebody could sue you for everything that you own. But if you create an LLC, which is a limited liability company, and you're operating under that LLC in that business, if something were to happen, then they can only come after the assets that are owned by the LLC, and you've protected your other assets.
Well, the attorney may have to jump in and say that you want to keep your accounting clean, your lines clean, because once you blur your personal account with your corporate account, your LLC account, then there's something called piercing the corporate veil, and they can come after you personally. But that's a whole separate conversation.
Yeah.
I have a question though about nonprofits. So if you take some of your personal income and you decide to, let's say you have a nonprofit, you decide to put a portion of it into the nonprofit, how does that tax write-off work? Is 100% of the money you put into the nonprofit, can you write that off, or how does that work?
So you do get, as long as it's a qualified charitable organization, you meet the limit. So let's say it's going to need to be over 10,000. So if you're putting that and you're making that contribution, then you're able to get a charitable deduction. But understand, a charitable deduction is not a dollar for dollar. A credit gives you a dollar for dollar, lessens your tax bill, but you will get the deduction for your taxable income.
So how does that work? So let's say I put $10,000 into a valid 501c3.
Like Spelman College.
Okay. So how much of the money? Agree. How much of the money would be? What would how would that look in the deduction?
So
I would get $2,000 in full. I would get what amount?
Right. So let me pull that back up. So here, so when you have your total income, you would subtract that above the line deduction. Hold on, let me go.
Yeah, I think it was a couple ahead. Yeah.
Here we go. So here, that's a deduction. So it would lower what your taxable income is going to be.
And it depends on your tax bracket, right, Tara? I think that's what the young lady is asking. Yes.
Because I'm going to go here, because what you're trying to do is this red box, you want to reduce it as much as you can, because this is the amount that's going to be taxed, and whatever that amount is in the appropriate tax bracket. So here's all your income. Then you start taking off your deductions, your pre-tax deductions. You get your AGI, and then you have your below the line deductions. That charitable contribution, it falls in the below the line deduction, because at that point, instead of taking a standard deduction, you're going to do an itemized deduction. And that's where you'll be able to itemize and show that, here we go. Yeah. Yeah, so below the line deductions, you're going to itemize. So that's when you'll be able to take that charitable contribution. So what that would do, and let's say you put that 10,000 into, you give it to Spelman, is that if your income was 100,000, your AGI was 100,000, and you gifted 10,000 to Spelman, and that then allows you to itemize, you would pay taxes on 90,000, not 100,000.
Got it.
Yeah, and that can have a big impact if, say, for example, that let's say that you were being taxed on 90,000, and let's say you're single, you end up 90,000, but if you made an additional 10,000, your taxable income would be 80,000, and that actually means less of your income is being taxed at 24% and more
Right.
at the 22%.
Right.
Got it. This is really convoluted and complex. Thank you very much.
So
And
ladies,
again,
we are at our time this evening, but what I'd like to do is first thank you, Tara and Tiffany, for the fantastic information. And to all my Spelmanites that are on the call, we have a part 2 coming up. So this is just the first bit on the tax piece. But please come back and join us again on December the 16th, where the session is on, it's all about trusts.
Yes.
So how we set up trusts will be our next session. So if you're not a member, I always have to do our plug. Please join the Alumni Association at atlantanaasc.org. Join-now. Thank you so much. Have a happy Thanksgiving, and we will see you in December. Take care.
Thank you.
all right, thank you all.
Ladies,
you so
take
much.
care.